Quantitative easing stuffed banks with reserves, money funds parked the surplus in overnight reverse repo, and quantitative tightening then unwound that stack in reverse. Through 2023, rebuilds in the Treasury General Account mostly bled out of RRP. By 2025, with RRP usage thin, cash swings hit reserves directly, leaving funding more sensitive to issuance and settlement calendars. RRP is sitting near the floor while reserves move sideways, meaning new fiscal cash builds or a faster QT pace would press on bank liquidity quickly. Liquidity is a balance sheet identity. On the Fed's liability side, reserves move as a residual to changes in TGA, on RRP, currency in circulation, among other factors. In shorthand, reserves is almost equal to Fed assets minus currency minus delta TGA minus delta RRP minus other. When the RRP buffer sits near zero, the marginal dollar for a TGA rebuild or for QT comes out of reserves almost 1-for-1. Money funds will not refill RRP while U.S. Treasury bills clear at yields comfortably above the RRP rate. Cash that once cycled into the facility now chases bills, so the system has lost its shock absorber. This is why a TGA drawdown has not produced a big reserve rebound. The flow is being intermediated by private markets, not parked back at the Fed. So, with RRP at the floor, reserve supply is tighter. The banking system bears fiscal cash swings directly and front-end conditions stay sensitive. If the TGA lifts by a large increment, expect reserves to decline by a similar amount and for that to show up in money market pricing, not in RRP usage. And, if bills cheapen further relative to the policy floor, the buffer remains absent and rate volatility around settlements, tax dates and coupon clusters persists. I'd watch out for several plumbing stress indicators, including the spread of secured overnight financing rate to interest rate on reserve balances for signs that reserves are brushing the ample scarce boundary, GC repo versus bills to see where collateral is clearing relative to the floor, bill overnight index swap as a proxy for the bid for safe assets, primary dealer balance sheet usage around refundings, and fails to deliver and DTCC netting frictions. If these pressure gauges stay quiet while TGA rises, reserves were still ample. If they tighten together, you are seeing the cost of a missing RRP buffer.